In August 1982, Brazil announced it couldn't pay its foreign debt. The shock rippled through Mexico, Argentina, across the entire developing world. But this wasn't random. It was a trap set in the 1970s and sprung by one man's decision in Washington. And the trap is still set. I'm David, and this is how it works. In the 1970s, Brazil made a bet. The country needed capital, massive capital, to build a modern nation. Highways cutting across the interior, dams spanning new rivers, factories and ports. The fuel for that growth was petrodollars, capital that oil-producing countries had deposited in Western banks, and those banks had more money than borrowers. Brazil looked like the perfect place to deploy it. A country with growth potential, sitting in the Western sphere, hungry to modernize. So the money flowed. Brazil borrowed aggressively in US dollars at floating interest rates. The interest you paid would move with the US prime rate. For a few years, it worked exactly as planned. The economy boomed, highways rose, dams filled, factories opened. There was optimism and growth, and investors thought they'd found the place to get rich. But every dollar Brazil borrowed came with an invisible timer. If US interest rates ever rose, Brazil's debt payments would rise automatically. The trap was set, and nobody in Sao Paulo seemed to notice. Here's where it gets dangerous. By 1980, those loans were working exactly as structured, which meant they were working exactly as designed to fail. Western banks had taken in massive petrodollar surpluses, and they were competing to lend them out at floating rates. It seemed perfect. The borrower takes the risk of rising rates. The bank collects a spread. Everyone wins. But there's a catch to floating rate lending to developing countries. It treats the borrower's currency and credit quality as irrelevant. What matters is the US prime rate. So Brazil's loan officers signed agreements that said, you pay the prime rate plus 2%. And the prime rate is whatever New York decides. And in New York, the Federal Reserve had a big problem. Inflation was rising. Prices were going up everywhere. The Fed needed to cool the economy, and it had one tool: raise interest rates. That would make borrowing expensive, discourage spending, and theoretically bring inflation down. But the Fed wasn't thinking about Brazil. Nobody in Washington was thinking about Brazil. In 1979, Paul Volcker became the chairman of the Federal Reserve. His mandate was simple: crush inflation, no matter the cost. Volcker believed the only way to kill inflation was to shock the system, raise rates so high that borrowing becomes painful and people stop spending. By 1980, the US prime rate was above 20%. It was the highest level in decades. Volcker wasn't wrong about what would kill inflation. Higher rates did cool the economy, but he wasn't thinking about what 20% rates would do to every floating rate borrower in the developing world. Overnight, every loan Brazil had taken became dramatically more expensive. A loan that cost 5% in 1979 suddenly cost 15 or 20%. Brazil's debt service, the annual payment owed to foreign creditors, skyrocketed. The country that had borrowed cheaply to build highways now faced a bill it couldn't pay. The trap that was set in the 1970s had sprung, and the developing world was caught inside it. For 2 years, Brazil tried to manage. It cut spending. It tried to earn foreign exchange through exports. It negotiated with creditors. But in the summer of 1982, the situation became impossible. In August 1982, Brazil's finance ministry announced something that sent shockwaves through every financial capital in the world. The country could no longer service its foreign debt. It wasn't a restructuring proposal. It wasn't a request for delay. It was a default. Brazil was saying, we cannot pay what we owe. And the timing couldn't have been worse. Mexico was on the edge too. Argentina. Across Latin America, every country that had borrowed in dollars at floating rates was facing identical pressure. When the news broke that Brazil couldn't pay, when creditors realized the emerging market wasn't good collateral anymore, they panicked. If Brazil defaulted, wouldn't Mexico? Wouldn't Argentina? What if the entire region stopped paying? The cascade had begun. When the news hit Washington, the International Monetary Fund went into crisis mode. The IMF's managing director was Jacques de Larosière, and his team understood immediately what was at stake. The biggest U.S. banks, Citibank, Bank of America, Chase Manhattan, had massive exposure to Brazilian debt. If Brazil defaulted fully and contagion spread to Mexico and Argentina, those banks would face losses that could break them. The global financial system could seize up. This wasn't a developing country problem anymore. This was a threat to the American banking system itself. So de Larosière and U.S. Treasury officials began emergency negotiations. The IMF couldn't lend Brazil enough to pay in full. The debt was too large. Instead, the strategy was triage, prevent immediate defaults, give creditor banks time to adjust their positions, and buy the system time to restructure. That meant Brazil would need a new loan from the IMF. But IMF loans never came without conditions. To prevent a complete meltdown, the IMF offered Brazil a lifeline, emergency loans, that would let it meet its immediate obligations and avoid default. But they came with conditions. The IMF demanded wage freezes for government workers, demanded cuts to social spending and public investment, demanded the currency be devalued so exports would become cheaper and Brazil could earn foreign exchange. All of this was imposed on a country that had just entered a recession. The people of Brazil paid the bill. Workers saw wages frozen while inflation eroded their purchasing power. The poor saw social programs cut, healthcare, education, subsidies. The middle class saw the currency in their pockets become worth less overnight. And the foreign banks, the ones who had aggressively sold loans knowing Brazil had limited ability to repay if rates rose, those banks faced negotiated losses but remained solvent. The cost was distributed entirely downward. The benefits of the 1970s boom were private. The costs of the 1980s bust were public. The crisis didn't stop at Brazil. Within months, Mexico announced its own debt crisis. Mexico couldn't pay. Argentina faced identical pressure. Across Latin America, countries that had seemed poised to break into the developed world instead sank. Economists call what followed the lost decade. 10 years of stalled growth, recessions, unemployment spikes, and austerity that ravaged the region. Universities ran out of funding. Hospitals cut services, infrastructure projects froze, factories closed. The generation of Brazilians, Mexicans, Argentines who should have been entering the workforce faced a jobs crisis with no end in sight. The data tells a brutal story. After years of growth in the 1970s, per capita income fell or stagnated for a decade. A generation had its development stolen. And the cause was clear. Floating rate debt sold at the wrong moment, combined with a U.S. interest rate shock that nobody in Latin America could control. By the late 1980s, the creditor banks needed an exit. They couldn't force Brazil to pay in full. The country clearly couldn't. But they also couldn't afford to simply forgive the debt and take massive losses. In 1989, the U.S. Treasury announced a solution, the Brady Plan, named after Treasury Secretary Nicholas Brady. The plan worked like this. Creditors could sell their Brazilian debt back to Brazil's government at a discount, maybe 50 cents on the dollar. Or they could keep it and restructure it at lower interest rates. Creditors took a haircut. They lost money, but manageable money. And in doing so, they exited the crisis. Brazil, by contrast, remained crushed. The country had to buy back its own debt at discounts or restructure at lower rates, which meant servicing it longer. A decade of lost growth followed. Wall Street had exited with losses that the banks could survive. Brazil had a generation of broken promises. Here's what makes the 1982 crisis not just history, it's a template. Look at the Philippines today. Look at Indonesia. Look at Bangladesh. All three have economies that borrowed in US dollars at floating rates. All three are vulnerable to the exact same shock that hit Brazil in 1982. A US Federal Reserve decision to raise interest rates in order to cool American inflation. The Fed doesn't think about Manila or Jakarta or Dhaka when it makes that decision. It thinks about the US economy. It thinks about American inflation and American unemployment. But when the Fed raises rates, it raises them for every dollar loan on earth. Those three cities feel it immediately. Their debt service goes up, growth slows, austerity follows. The playbook is the same. The leverage is identical. And the outcome is predictable. Emerging markets that borrowed in dollars are always one Federal Reserve decision away from a crisis they didn't cause and can't control. The 1982 Brazil crisis wasn't a unique disaster. It was the first time a specific trap got sprung, and it wrote a playbook that repeats. Whenever the US Federal Reserve raises interest rates, whenever it chooses to cool American inflation, the same sequence unfolds in the developing world. Emerging market debt becomes unaffordable. Growth collapses. The IMF arrives with austerity. Workers see wages frozen. The poor see services cut. And creditors in New York take manageable losses while the global poor pay the bill. The bigger risk the data exposes is this. The structure that created the 1982 crisis still exists. Dollar-denominated debt. Floating rates. A central bank in Washington that sets rates for the entire world. As long as that structure stands, the trap remains set. It's not a question of if another crisis hits. It's a question of when. Which developing country gets caught first, and whose wages freeze next. The trap is still set. Dollar debt, floating rates, a Federal Reserve that raises rates when it chooses. If you want to understand why emerging markets are always one Fed decision away from crisis, like and subscribe. I'm David. See you tomorrow.